There, we're on. We're good.
There,
Welcome to Tradier's The Trader's Edge Show. I'm Jim Muriel. As always, Bobby Chino. Bobby, we heard from the chairman last week, and he opened the door to 75 basis points of easing, which of course the futures market took to mean 150 basis points of easing. But then we heard Barkin and we heard Bostic, and the winds are blowing back and forth. Do you think he said what he meant to say or no?
Can I point something out about Barkin specifically?
Sure.
So we always talk about how ridiculous the Fed is in their mode of communication, and we go back and forth on whether it's an effective way to do it and whether they're going to say they're going to ease before they ease, blah, blah, blah. One of the things I put out the other day was that Powell had said back in 2021, and he prefaced it by saying, I've said this multiple times, but the SEP, Summary of Economic Projections, which is the dot plots, is not a prediction. It's not policy. It's just where various members think things are going to be. But then in the press conference, he didn't walk those dot plots back, did he?
No, he didn't. Yeah.
So today, Harker is talking about, he's kind of waffling back and forth. And then one of the last statements I saw quoted up on the Bloomberg was this: we should hold rates where they are and start to bring rates down. What the fuck does that mean?
Okay. That's interesting, isn't it?
What does that mean?
It means nothing. And it also means that them being transparent does us no good because it's all nonsense, nor do they know what they're talking about. Now, you and I can go on this. We have had shows where we go on for 45 minutes. And again, one thing I've always said, and I'm going to say again, you can listen to Bobby and I and think we're full shit. That's fine. But you can't deny the fact that we get some excellent guests, and today will not disappoint. We have the CIO of the energy investment firm Bison Interest, a person who I respect's opinion a lot. We have Josh Young. Josh, how are you?
Hey, I'm good. How are you?
Good. Okay, let's go over the ground rules first. It's very complicated. So first of all, I ask you questions. We start going down paths that you think are stupid. You call a timeout and say, this path is stupid. This is what I really want to talk about. This is not going to surprise you. It's a very informal conversation. Secondly, Bobby told me before the show that for some odd reason he's crabby. So you and I have the second objective of trying to make Bobby less crabby. Do you agree with those? Do you agree to those ground rules?
Sounds great. I'm in.
I don't know that it could happen.
No, it's going to happen. I don't know what you're crabby about. It's almost Christmas.
It's 68 degrees here in Florida. I'm freezing.
So share with us what the problem is. Both of us, we can be your support group.
It's 68 degrees here in Florida. I'm wearing long sleeves. I'm freezing to death.
It's like 20.
Where
are you, Josh?
I'm in Houston. It's also 68 degrees here. It's wonderful. I love this weather.
I can't even bend my hands.
Be more like Josh, Bobby. So how long have you been in the business, Josh?
Finance, I think since, 2007. And we launched Bison in 2015.
Good. And things are going well, I hope?
Yeah. I mean, this year we're down slightly, which is tough because the market's up a lot. But, 2021, we were up like hundreds of %. And so, you gotta have your down years with your up years.
Hey, I got a question really quick, Jimmy. I'm sorry, but Josh, so in finance since 2007, right? So and Jimmy knows this, and this allows us, Jimmy, to bring up almost one of the mottos for the show by Mike Tyson. But I was in an interview as the Fed probably hiked rates about 375, 425 basis points at the time. And it was a Bloomberg interview with a younger anchor. And she asked me about interest rates. And I said, about 37% of the S&P 500 C-suite was in university, high school, or neither the last time rates were this high. So you sort of fall in that group. Now, she jumped on me and said, they can read though, Bob, which I'm like, oh yeah, she's in that age group, right? So she got upset with me. But Jimmy, you want to say it or should I say it?
No, say it. This is the motto of our show. We always talk about it. Go.
Everyone has a plan until they get punched in the mouth. That's a Mike Tyson term. So how are you handling rates that, I'm not going to say you've never seen them, but rates that you haven't been managing money in?
Yeah, so starting investing in 2007, I was at a family office. I had been investing personally for a number of years before that, but that was my first sort of professional sort of investment job. Late 2007, I was at a private equity firm briefly before that, and it was, I mean, the introduction was getting punched in the face, right? It was 2007, oil and gas prices rip. I wasn't just doing oil and gas at the time. Everything else gets destroyed. And then mid 2008, you feel brilliant. And then absolutely just, more than punched in the face. And since then, it's been mostly rough for oil and gas. 2008 was sort of the peak for commodities. People think it was 2014. There was sort of this echo rally from, 2009 to 2014. So it's really been rough, and that's actually why we named the firm Bison. The bison is the only four-legged animal that faces into the storm. So we expect things to be tough.
I love that.
That's kick-ass. Nice. I love that. Yeah. I had another question for you. Where'd you go to school?
I went to the University of Chicago.
Oh, I've heard of that place. Are you from Chicago area?
I'm not. I grew up in Santa Monica, California. My grandpa got his math PhD at University of Chicago, so that's sort of the connection. And then when I visited, I wasn't sure if I wanted to go because it seemed really hard compared to some of the other sort of top-ranked schools. But I went to this symposium in honor of Milton Friedman. I got to hear actually Milton Friedman talk, as well as a number of other Nobel Prize-winning economists. Wow. I really liked what they were saying. I didn't know what I wanted to study. I didn't know where I wanted to go to school. And I was like, I'm going to the University of Chicago. I'm going to study economics.
That's outstanding. That's really cool. Okay, let's get right into it, if that's okay. We just had, Doomberg, the green chicken. So we just had him on our other podcast, and I think he's a brilliant energy analyst. And I had been bullish oil for the next 2 to 5 years. And I still am somewhat bullish oil. But he tempered me from that a little bit because he was talking about glut of natural gas. He was talking about the fact that the Biden administration has actually pivoted some on energy policy as it relates to fossil fuels and as it relates to nuclear. What are your thoughts on the couple of years, the political ramifications of having people who claim to be anti-fossil fuel?
Well, I think it's a really different business to be in investing and trying to sort of make money on what the narrative is going to be, let's say 18 months from now, versus informing people on sort of what's happening and helping them understand sort of current trends and sort of current stuff like media, like subscription services and so on. So, I think those are just very different things. So I would say that the Biden administration has been less terrible for oil and gas production in the U.S. so far, but I think things are getting worse. Regulations are getting more onerous, and actually, people are very bearish oil right now, and speculative positioning is very negative, partly because they think that shale is going to grow like it did previously, and the reality is that we're starting to see production roll and activity has fallen. So it's easy to see things, I think, in the rearview mirror. It's harder to do what sort of Doomberg was doing, which is sort of characterize what's happening right now and how we got here. And my job is to figure out what's going to happen 18 months from now and or 2 years from now and sort of solve for that. So it's sort of a different perspective, I think, mostly driven by time frame and sort of concern in terms of, forward time frame as well.
All right. So you're an energy investor. I assume that means commodities as well as energy names or ETFs, or no?
No, we're focused entirely on equities and equity-related securities. Occasionally, we'll do that.
Great.
We don't do the physical, and we won't trade the futures generally.
Okay, so in an equity sector backtest that we did, you look at the 2 times that energy is basically the best performer all in, right? Whether you're looking at yield or returns or risk-adjusted returns, and those are reflation and stagflation, those 2 environments. So would you say that either one of those would be your base case for 24 or no?
I think it's just hard. I guess I don't need to sell subscriptions, so I don't really need to make that call. My call is valuation driven. And when I look back at times that oil and gas equities have done well and broader energy equities have done well, it's mostly been from sort of low valuation bases, low percentage of participation in the broader index, to larger. They basically go from under-owned to reasonably owned to over-owned, and we're still sort of in that under-owned sort of extreme range. So I think about it less about economic conditions. There's a lot of different potential economic conditions, and I mean, the funny thing about it is no one knows what the future holds for economics, and like once you realize that, it's very freeing. So
okay. But I want to, and I need to stress, this is my opinion, not Josh's, because we have to be careful about trying to put opinions in his mouth. But so it seems to me, because my base case is that we will not have 2% inflation next year. So almost by definition, the sort of mood of the market is going to be inflationary, because if we don't continue to see disinflation, I almost feel like the market's going to overcorrect thinking about inflation. And if that's the case, and energy names are under-owned, then theoretically it could be a very good year for some of the under-owned energy names. But you don't have to agree with that, but you could say, I hope so. Or, I mean, am I nuts?
No, I hope so. I mean, I think the risk is, as you were talking about that, I think the risk is that we're actually in a deflationary period where there's a terrible crash and our economy is horribly mismanaged, which, I mean, it is. And there's a huge regulatory burden in the US, and there's a lot of policy failures internationally. And there's debt issues in China. There's all kinds of sort of known problems and risks. So the risk is that manifests and we end up in a deflationary period, which would be terrible briefly for oil and gas equities. The other risk is that it would be, very inflationary, like you're describing, where we sort of had this inflation pause. We had disinflation, where inflation slows down and then it speeds back up, and maybe this Red Sea issue causes it, as you have shipping delays and similar stuff to what we saw in 2021. Maybe not. The important thing, I think, people get very, very scared about a potential recession, particularly in the US. And what I think we saw between 2008, the response to that, as well as the response to the financial downturn during COVID, is that there's a fiscal and monetary response that I think the policymakers feel very comfortable with, which is they'll drop rates, they'll bail out banks and guarantee financial institutions, and then they'll send checks, particularly to sort of the poorest people, and they'll send a ton of money. And that combination is incredibly, incredibly promising for oil and gas equities. And so I sort of want it to get kind of bad. And again, like I really don't want, I want everyone to do well. And my optimal scenario is global growth in a sort of Pollyannish situation. But from an equity perspective, 2 years out, like COVID was great for oil and gas equities on a 3-year basis. It was stressful and terrible on a very short-term basis, but using a multi-year perspective, even if we end up in that sort of deflationary, terrible scenario briefly, knowing what the very likely policy response is, which is just helicopter money, along with QE, along with too big to fail institutions, it actually could look amazing, and that's one of the paths to all-time highs for oil.
So a couple things. First of all, when you, like, our audience is sophisticated, we have a job to do. And if we're taking advantage of bad things happen, that is they know that we're not talking about the fact that we don't have empathy and compassion. So you said it perfectly, but they know that perfectly too. Secondly, the same administration 2 years ago, in the same week, knocked around a law that would not allow fossil fuel companies access to capital markets. And then the same week they called them and asked why they were pumping less fuel. And it's obvious to a third grader why that would be. But the question I asked before is, Doomberg said has seen a pivot on fossil fuel. And you said onerous regulation. I agree with you 100%. You know where I stand on this. I've read about it all the time. But do you think they're going to lower regulations or ignore regulations for this election year to try to keep the price of crude down?
No, I mean, it's just not in their policy DNA. There's no evidence of lowering regulations, even in alternative energy, where they're simultaneously subsidizing it and also enforcing and increasing regulations that prevent alternative energy projects. So no, I will strongly disagree with that. And I'd love to see evidence of it, because that's just nonsense. And I think there's this sort of attempt among people that do these things to try to sort of seem balanced and whatever. And look, like, there's no reason to try to sugarcoat stuff when it's just wrong. That's wrong. They hurt their own policies, even on the things that they're fully aligned with, because of NIMBYism, because of sort of other, it's complicated. So no, I don't think there's even a shot of that. And, again, like, just the easy answer is look at the regulations on manufacturing of electric vehicles, look at the regulations on manufacturing of solar panels and wind turbines, and then the installation of those. I mean, just not even close. They can't get out of their own way. They're failing so miserably. Right before this, I was listening to a Twitter space by a bunch of maritime experts, and they were talking about the gross policy failure in the Red Sea, and how the Department of Transportation and the military, they've like defunded naval experts and de-emphasized the Navy so much. And they're doing this weird thing where they're not protecting anyone, but they're trying to protect all ships, not just US flagged ships. And so there's just such extreme policy failure that you're getting like, by trying to do everything, they're doing nothing. And I think it's a similar sort of thing with energy. So absolutely not. And I wouldn't hope for any sort of regulatory respite.
I'm so glad we got you fired up. By the way, Doomberg also, that was a minor thing that he said. And a bunch of the things you just said, he said the same exact thing, particularly mining for the materials that are needed for this green revolution. And we're like, we need the green revolution. Oh shit, no, we can't. We're not mining for that stuff here. You can mine for that somewhere in the Congo, but we're not touching that here. And how just absolutely hypocritical and shooting themselves in the foot is. Besides, when you see Bobby and I do hand signals, that's for us back and forth. You keep talking as long as you want. That's what you're here for. Bobby and I like try to arrange our questions based on that. But Bobby, I wanted to bring you in then next. Yeah.
Yeah, can you clarify how you feel about that, Josh? I didn't really understand.
Yeah.
With a hammer. That's what we're talking about.
I think
it was fantastic.
Great. I think it's just really important to understand sort of who you're listening to, what their time frame is, what they're interacting with. And so, if you really want to understand what's happening right now, as well as what may happen in the near term, Doomberg is a great resource, probably one of the best, and also really good for historical context. But I found, looking at some of his team's calls on these things, it's been a little tough to it's just a different time frame than I'm working with.
So some of these big integrateds pay a dividend. I was always kind of under the impression that as rates plummet, some of these people flock to these stocks. What percentage, and I know obviously most often that they're correlated with the price of the underlying, which isn't always realistic, but that's just what the market does. It's an input cost for some of these companies. But do you think people will buy the names based on dividends if rates continue to plunge?
Honestly, I don't know. I think that the integrateds have an issue, which is that refining margins have collapsed. And also chemicals pricing is pretty tough. So, a big portion of their earnings stream is challenged. And then oil and natural gas prices are also down quite a bit from last year. So on a year-over-year basis, they're not looking great. And they may actually get worse. Even if oil prices rise, refining margins, the 3-2-1 crack spread, last I checked, was sort of 24, and it was 60 something at various points last year. So that's not great if a big portion of your business is refining. So I think that I think the fundamentals are going to be in contrast with maybe some of the dividend-oriented fund flows. And I'm not saying they can't fund their dividends. I mean, frankly, some of these guys funded their dividends at negative oil with no one driving during COVID. So I'm not saying they won't. It just, I think they're running into some issues, and I think it's sort of an open question. I'm not invested in that space, partly because there's way better value small cap, and also, I don't really understand the appeal of refining here at the current valuations. I like refineries at a huge discount to replacement cost, and that sector is trading sort of rich relative to sort of a traditional value investor metric.
Do those small cap names, are they as highly correlated with the price of the underlying as some of the big integrators are, or no?
They actually are more so in some cases, and then less in other cases. Some of them are totally random. There's this one stock we're in that I want to mention. It's like sort of inversely correlated with oil and natural gas. It's very, very odd. There's others that are 2 or 3 times correlated. And then there's others that are just sort of more event-driven type theses where they'll sort of trade in line and then, a good well result, or they turn on a power plant or something else, and you end up seeing sort of a big non-correlated move. So I think the smaller caps are much more idiosyncratic. What I was highlighting was that there might be a trading pattern historically for the integrateds that might actually break at some point, where you see sort of a big move based on an earnings report or a change in an analyst estimate or something like that, because there's this potential for the earnings trajectory to be different than in past cycles because of this sort of difference in refining margins and then also in chemicals earnings.
Josh, where do you fall in the SPR conversation?
So I actually think that withdrawals from the SPR are bullish medium to longer term because they remove a source of potential supply. So it's not 100% treated like inventory. It's probably the right way to treat it as sort of temporary supply. But if you have a temporary supply of something that you use every day in a similar quantity, more or less, and then the supply goes away, and it's finite, then that's actually potentially quite bullish. And the less of the potential supply there is, that tends to come on when prices are higher and the market's undersupplied, the more of a risk of sort of an overshoot. And because of the presence of the SPR, as well as the historical presence of significant OPEC plus spare capacity, as you run down these things, both the SPR and as OPEC, they keep lowering their quotas because they haven't been able to deliver. And everyone's like, oh, it's so wonderful how they managed to finally agree with each other after like 40 years of cheating. And it's like, no, they didn't change. They're just, their oil fields are running out of oil to some extent. Their spare capacity, they never restate their reserves, right? So they've been producing, but their reserves don't go down. They didn't drill very much other than a couple of countries somewhat recently. So anyway, both SPR and OPEC plus, like, they are setting things up very nicely for higher oil prices. And I think Biden isn't planning on that. I think it's just very bad policy and a very bad understanding of the economics around it. I think they just have bad advisors that are misleading them. But on the OPEC thing, I think that's sort of intentional. I think they wouldn't mind higher sticky prices for a multi-year period.
Well, that's what I'm wondering. Like, when you look at the response, say, for example, of the Middle Eastern countries to the U.S. trying to put together a task force, which is ridiculous.
I want to be on a task force. It sounds cool.
Yeah.
Anyway, go on.
I can get you on one, but it's not. You'll have a badge, but we talk about it offline.
Okay, good.
So essentially, you get no Middle Eastern countries, except I think Bahrain, that was participating in the task force to try and alleviate some of the problems in the Red Sea. I mean, Saudi Arabia said no, UAE said no. None of them want to get more involved in a conflict, or at least be perceived to get more involved with the West when there's a conflict going on that in theory is a Muslim conflict versus, let's just say, others. So when you see from that perspective, I still could totally see something Jimmy's brought up a bunch of times, that if the SPR stays at this level for a long period of time and prices start to go up, that there could be a predatory cutoff of supplies temporarily, whether it be geopolitical or deliberate, where we just wouldn't have a whole lot to lean on. Am I crazy?
Well, so there's a few things. So first of all, apparently the Biden administration cannot do math, and this may not be a surprise to some or maybe horrifying to others, but it's really not very complicated. And frankly, Trump's advisors couldn't really do the math towards the end of his administration as well. The US at this point is actually an energy exporter, not an energy importer. And yeah, we import some heavy oil and we export some light products, but the reality is we produce plenty. And our production is very labor intensive and it's very manufacturing intensive. It's a giant mistake for the US to be trying to engineer low oil prices. We should be trying to engineer radically high oil prices to employ millions more Americans and generate real manufacturing driven GDP instead of government driven sort of fiscal overspend nonsense. So it's a huge policy error. So just to highlight that, they're messing up on that. One other thought that came up in this among these maritime experts I was listening to, they pointed out that here the U.S. is leading a coalition for the shipping of stuff essentially from China to Europe through the Middle East. So why isn't China leading that with the EU, right? And China's funding probably some of these guys that are shooting at us, right? Or shooting at Israel or whatever. They're like buddies with them and they support them in the UN and vote with them or whatever, right? So great. So China can deal with it. And China supposedly has this naval force. We've never really seen it, but great. They can take care of that to some extent. In the EU as well, they underfund all this stuff and it's sort of this mess. So anyway, I don't think it really makes a lot of sense to try to read through some of what's happening to almost anything else except that our sort of displayed incompetence. And again, this isn't just an issue, I think, for Biden. Again, Trump sort of had some of these issues too. But when we display impotence and incompetence globally, we increase the risk of that sort of disruption. And when you look at the numbers on OPEC and OPEC Plus, and you look at sort of where the countries are situated in terms of the ability to deliver supply, as well as their sort of fiscal break even. I saw a report recently from some economic consulting group or whatever. They said that Saudi Arabia needs $108 Brent to break even on their fiscal. And yeah, they can borrow money, but do they really want to? It's sort of a weird thing for an oil exporter of the scale of Saudi Arabia to have to potentially borrow money just to cover their bills. So I think what you're saying is really reasonable. We could end up with an oil embargo. Iran has already talked about it. They may be starting with this sort of attacking. They're only attacking cargo ships right now. The Houthis, this Iranian proxy. So they haven't hit oil yet, but maybe they wouldn't hit oil there. Maybe they'd hit Saudi oil, or maybe they'd hit some other sort of thing to enforce it. Or Iran ramped their production by 800,000 barrels a day. They might actually not have those were their exports. They may not have the production capacity to do that. If Iran cut their exports by 500,000 barrels a day, they might get $20 a barrel more if they did it around the same time that the Saudis cut again, Russia cut again, et cetera. I mean, the market's so tight that you could potentially, and so well balanced, you could potentially have a 1973 or 79 style price shock with a very, very small amount of oil offline. So I think it makes a ton of sense to think about it. And I think you want to sort of contextualize it because people have been fading oil geopolitical risk, right? The trade has been sell oil, sell energy stocks anytime they go up on geopolitical risk. And the reality is that it's real, it's happened, and the people that have the power to do it can read a history book and they aren't happy with the current price. And they're involved in some of these conflicts and not really happy with what Israel's doing and not really happy with what the US is doing, not so happy with what Europe is doing. So, I mean, it's in many ways similar. I'm not saying it definitely happens, but anyway, it's a great question. It's really complicated. And there's probably a lot of stuff I'm forgetting and maybe some stuff I'm getting wrong, but I think it's really worth considering.
All right, I want to throw this out there because I think this is for all three of us. There's a question from a viewer that's come up. And it's from MM79, who's been on here a bunch of times, I believe. I believe he's a regular of ours. Have any of you read The Moral Case for Fossil Fuels by Alex Epstein? And if so, what do you think about it? So I've just seen that start to pop up in conversations. So I haven't read it, but it is, I could literally grab my notebook. It is on my list of books to get and read. Either one of you seen it or read it?
He sent it to me, and I read a little of it. I think I know what the gist of it is. Have you read it, Josh, or no?
Yeah, I mean, I have Fossil Future on my bookshelf, which is the next one, and is also they're both excellent books and worth reading.
And the gist of it is that we run on fossil fuel, and if you try to take it away, lots of people are going to suffer, and they're going to be people who aren't as well off as us, as poor people. That's got to be part of it, right?
Yeah, I mean, my suggestion would be. I don't know if Alex will like this. I met him a few times. Really nice guy, really smart, worth listening to, worth reading. If you don't want to commit to reading a book, at the very least, find one of his talks on YouTube and watch it and spend 30 minutes or whatever getting educated. I think you can get most of there are some great charts and some sort of very sort of interesting logic that he uses that I think is worth considering in his books. But I think you can get sort of the high points and figure out for yourself sort of how much you want to read the rest of his stuff by listening to one of his talks. And I'd highly recommend it. He's a top resource in the space for understanding sort of Schwann's paradox and some of the other issues that really I think are important, that I think our policymakers get wrong, and that are going to be more and more important over the next few years.
Okay, you a second ago you talked about incompetence, and by the way, for the people who are listening to this, I think one of the solid takeaways, and I love just to underscore the takeaways, is that our economy from a macroeconomic standpoint would do much, much better with higher oil prices based on our production levels and what we do now. I love that point. You said something about political incompetence, and you probably know that I've deviated from that explanation. I think they're very, very competent in what they do, and I think keeping oil prices down and doing their best to keep oil prices down is to keep their phony baloney jobs, because people don't like high oil prices. You will allow for that possibility, correct?
Sure. I think they're trying to keep oil down. I think it's just illustrative of a failure of understanding actual, even like Keynesian economics. I think they just don't understand that. They don't understand classical economics. They do understand short-term market price manipulation. I will give them that.
Okay, good. Bobby?
Yeah, so I want to. Part of the reason that I reached out to you wasn't just because it seemed like you were being shadow banned. I saw a tweet of yours, an ex of yours, whatever the hell we call them, where somebody said that they hadn't seen your stuff in a while, and I'm like, I haven't seen Josh's stuff in a while either. So I started going through the last few days. That same day, a really, really close friend of mine down here in Southwest Florida sent me one of your tweets. He doesn't know that I know you, right? And he sent me one of your tweets with just exclamation points all over. Is this true? And I want to put that tweet up there if we could. And it was, Buffett has been adding to his oil and gas stocks, particularly Oxy, which is public knowledge at this point. I've been buying two smaller oil and gas stocks of the sort that Buffett would buy when he managed money. Others have been selling. I'll continue to be a bison, essentially, a face into the storm. So based on that tweet, number one, I don't know if you're able to talk about what you've been buying, but let's talk about the whole sort of background of the tweet and share whatever you're comfortable sharing off of this tweet.
Sure. Yeah. Okay. So we looked really closely after Buffett started buying Oxy in March of 2022. He helped fund their acquisition of Anadarko and got convertible preferred equity, or preferred that gave him shares. He was selling those shares during COVID at like $10 a share, $8 a share, $12. He was selling, and ironically, Carl Icahn was buying. Then when Carl Icahn was selling, apparently it turned out Buffett was buying in the 40s and 50s dollars a share. And so we looked really closely because people were saying a lot of different things about Buffett and what it meant. And they were really, I'm not the biggest Buffett fan, but I think it's important to understand what people are good at and what they're not. And often people are, when you think they're an idiot, they're probably smarter. And when you think they're evil, they're probably a little less evil. And when you think they're brilliant, they're a little less so. And if they're so good, they're probably a little less so too. I think people are sort of pretty similar, more or less. So looked really closely, and people are really negative on Buffett on oil and gas because they pointed out a couple of poorly timed purchases that Buffett had made for Berkshire that lost money. And when we looked at the history, almost every investment by Berkshire, as well as almost every investment by both Buffett and Munger prior to Berkshire, were highly profitable. Some of the most successful investments they ever made were in oil and gas from an IRR and ROI perspective. And there were a couple. Munger got like 100x or something on a oil field services company that owns some oil. That actually was one of the things he rolled into to actually get his stake in Berkshire Hathaway. So, it's important. I think people miss running a fund and running money professionally. Like, you don't have necessarily, you're not able to sort of fund it with your other assets. You have money that's coming in that you're either sourcing from selling ideas, or you're sourcing it from dividends or margin, or however, or holding cash and then deploying it. It's a really complicated and different game than managing private wealth or personal money or whatever. And so one of the things that Munger was able to do that's relevant for professional money management is his trajectory of wealth was such that he made so much money on this one oil field services name that ended up, I think it was Belridge, or I'm blanking on the name, but one of them just so enormous. the timing was good. He was able to sell that and then buy a big chunk of Berkshire, and that ended up sort of starting. So he got his millions through the oil name and then billions through Berkshire and holding it and allowing it to compound over time. So we looked really closely, extensively. I've been to Berkshire a few times. I've never met them personally, and obviously the time is up to meet Munger, and I don't know if Buffett will ever meet me, but hey, it'd be real interesting to see. But listening carefully to everything they said about Oxy as well as their oil and gas investments, we really wanted to get this right. And I know this is taking a little time to explain, but we did a white paper on it to try to walk through. We analyzed all their investments. We highlighted select ones that we thought were relevant for the question about Oxy, and paid close attention to what Buffett had said about managing his personal money, which has become more of an issue recently, as people talk about, hey, did he invest personally in stuff that Berkshire was buying or selling? Like, what's he doing with his multi-billion-dollar PA in addition to his Berkshire investments? And what Buffett has said, our conclusion on this was that Buffett was buying Oxy because it was a levered oil producer, and it gave him sort of the most exposure that he could get for Berkshire Hathaway in buying one oil and gas name to rising oil prices. And again, based on all his statements and all this stuff, that was our assessment, that was our analysis on it. And then he also was buying Chevron, which was integrated, higher valuation, less torqued, but there were other aspects of Chevron, very good deal maker, very sort of, it would make sense also, given that he funded Oxy outbidding Chevron with preferred stock, that he would go and buy Chevron, which behaved extremely well. Great capital allocators. Mike Wirth is sort of, a legend among the sort of great oil and gas CEOs. So it makes sense that he would go buy Oxy, a ton of it, to get oil price leverage in a single name, that Berkshire didn't have to go buy a basket or any, that's not his style, and then buy Chevron to get some oil price leverage, but also, his sort of quality, get a dividend that he can go reinvest and do other stuff. And so that sort of explained his purchase there. What I meant in terms of the smaller names is, if you listen carefully, it doesn't get a lot of airtime when people cover Berkshire or whatever, but if you go or you listen to the live feed, he talks about it typically a few times every year in every meeting. He talks about how you have a huge advantage as an individual investor because you can buy stuff that your broker doesn't want you to buy and that institutions aren't buying. And he's talked about at the meetings that I've been to, how if he were still managing $50 or $100 million, he could put up consistent 50% returns. And so I haven't done that. That would be wonderful. But, there's not many people in the world who ever done that more than a few years in a row, despite what people say on Twitter. But it is possible to do better than Buffett does by buying smaller stocks like he used to do, like he says. So that's what I was alluding to. That's what we're trying to do. We're trying to find smaller producers that I think Buffett would be more interested in if he was running $50 or $100 million in the style that he used to invest with decades ago. So a lot of history and context there for one post. But a lot of that we've shared publicly and in white papers and other sorts of discussions like this. And I think it's worth, even if you're not the biggest Buffett fan, it's worth really looking closely at how Buffett has been investing and how that's evolved over time. And then I think the lesson of, be careful of professional money managers, be careful of brokers, be careful of services and all this stuff, and just like try to be smart and careful and study and just buy stocks that are really cheap. I think that's sort of an enduring message, and I'll convey that as well where I'm able to, like I did in that post.
So Bobby wrote a Substack last week, which I thought was really, really good. And the thesis of it was because people on the left will look at me and scream loudly, "We're pumping more oil than we ever have. You're crazy about your onerous regulations and this sort of bullshit." But the point Bobby makes is that it's literally whatever your policy is now, your production levels now, is reflective of policies that were instituted up to 5 years ago. And I don't care about politics. I don't care about Donald Trump. I care about policy. Can you speak to that a little bit? Is this number that we're producing, is that something that's a mirage, or is it really a victory?
So we really are producing a lot of oil right now. I think the right way to think about it is that there's no one who runs a regulated business that liked the economy under Obama or likes the economy under Biden. There's no one, right? You can't find people that like it unless they're sort of big subsidy beneficiaries or got a giant check. But outside of the direct economic intervention, no one.
You're talking because of regulation, because of
it's
business being the crosshairs of the administration for the most part.
absolutely. It
Yeah,
gets
the guys who run the Ford electric car division, they like
Yeah,
it.
they
But
love
other
it.
than
Right.
right. So it's way harder to run a business now than it was a few years ago. There's way more regulatory intervention. It's way more expensive. You're paying your lawyers way more. You're at risk way more. Even if you're trying to be totally law abiding and above board and whatever, you're a target. You're like who they're going after. If you're a law abiding citizen who has a small business and trying to grow it, trying to whatever, especially in oil and gas. So that being said, it is the United States of America, and we have wonderful institutions that were built over hundreds of years by mostly well-intentioned, law-abiding people with good values. And so it takes a long time to destroy that or mess that up. And so unfortunately, we're riding on sort of what do they say, like standing on the shoulders of giants. So we're sort of riding on a lot of these institutions and on private property rights and so on. And they are being diminished, but it's hard to go that fast from sort of free market, which again, we weren't a free market economy 20 or 30 years ago either, but it's hard to go from relatively free market to relatively command economy over a few years with our current sort of civil regime. So they're doing what they can to limit it, but there's also just sort of a reality. So everyone talks about it. And the reason the politics matter is that the trajectory of these things has a big compound effect on per capita GDP. And per capita GDP is the change in that is the best indicator of the trajectory of poor people and disenfranchised people in a country. So you want per capita GDP to be growing at a fast rate. So that way you have more and more people rising out of poverty. And when you have the opposite, like we had under the Obama administration, frankly, under Trump to some extent too, and then very much so under Biden, you end up with enormous inequality, as well as, which is actually sort of a feature, not a bug, because then that gets used as an excuse to continue policies that implement that. So again, this isn't a Democrat versus Republican thing. Unfortunately, both parties are sort of both statists at this point. But relatively speaking, Trump reduced regulations and Obama increased regulations substantially, and Biden has been sort of reimposing and adding to regulations relative to where they were before Obama. So I think that's what you see when you look at an oil company. You say, okay, like how much are you spending on X, Y, or Z things that are not production costs, not drilling costs, and so on, radically higher, and it's just getting harder and worse relative to a few years ago.
So this is funny. I just want to add this before I give you the question, Bobby, is that during the Obama administration, and the stock market would rally, and I go on some of these TV shows, and they'd be like, "Well, stock market's rallying; they must like things." No. This is the way the Fed has to compensate for crappy regulatory environments, and the fact that the whole corporate sector is in the crosshairs of these things. So the Fed keeps pumping money into the system, and then the rich get richer. I happen to be on the right side of that equation. Like I could just sit back and just say, oh yeah, he's doing a great job. Yeah, he's doing a great job for me. He's not doing a great job for the company. I just want to add it because I know you think the same way. Obviously, what you said. I don't even know why Bobby and I are here. You're saying all the things we want to say. Bobby, what do you got?
What I was going to say is, like, I keep trying to express to people that are pointing out how much we're pumping now, something that Doomberg said, and I hate to bring him up again because we just don't generally get two energy shows in a row like this. And I'm just a geek for energy stuff. But he said something that struck me. He said, people call Apple a technology company. They call Microsoft a technology company. He goes, if you've ever been on the floor of like a Chevron or an Exxon or some of the drillers, those are tech companies. And we kind of lost our way with the word tech, right? Where technology, the cotton gin was technology, right? It's not necessarily manufacturing that has technological advances, but shale drilling has. And people will say, we're doing the most we ever have. So obviously Biden isn't doing anything wrong. And, I did it again. I promised myself I'm going to call him President Biden rather than Biden, because it used to aggravate me when people would call President Trump. And I don't really care for either of them. I need to stress that as well as human beings. But when you look at it from the perspective of an administration, and I'm talking about this one, but it happens all the time. An administration will blame the prior administration for what's happening 2 and 3 years later, but take credit for anything good that's happening now without saying, well, that's because of the prior administration. And I just can't understand why the public can't separate the two. It's like you take the credit for jobs being quote unquote created, which we know they weren't created after the pandemic. So many more of them, the vast majority of them were recovered, not created. And then they say, well, no, the problems in the economy with inflation are because of policies by the previous administration, but the 13 million barrels of oil a day are because of our policies. When we know exactly it's not because of the policy. So on the back of that, I ask you, am I wrong for being pessimistic about U.S. production in the future? Because to me, there's only so many ways, so many little slices you could take out of the pie before the pie shrinks if we get another administration, Republican or Democrat, that isn't pro-fossil fuels.
It's such a complicated question. So I think generally I agree with what you're saying. There is just there's a simple economic justification for what the politicians are doing, which is that it's very inefficient for anyone to care about any of this stuff, because ultimately what you're doing is once every 2 years or once every 4 years, you're going and voting. And frankly, your vote there's almost zero economic value associated with it. It's probably value destructive to spend the time to go and vote. Everyone tells you to vote, but like your actual voting decision is sort of marginal. The decision to allocate any time or effort to any of this stuff as an individual citizen who's not, talking about this stuff publicly, who's not whatever, you're just as citizen number one or whatever, like it's totally uneconomic and totally inefficient to do it. So what they're doing is something totally different, right? They're playing a game for their donors. They're playing a game for their super supporters that are going to go and spread things. I mean, it's sort of messed up in the US where the super supporters for one party are all of the news anchors and all of the news reporters. So they'll just like repeat the same nonsense. And like you try to watch TV, like actual television, and it's just, although even like Netflix and stuff, these things are just so terrible, right? It's just the same set of messages. And it's not that I love the other party's message. It's just, hey, if there's like one party and they're on TV all the time, I mean, it sort of reminds you of these like dystopian movies, right? Or like a 1984 or a Brave New World or whatever. I mean, you're not that far from that in terms of just like what they show life is like in those sorts of regimes. So I think that's what they're playing for. I think they're not actually playing for something logical or reasonable. So that's my comment on sort of the commentary. If it sounds inane, it's because it is. And like trying to argue about it is also not productive because it just doesn't matter. So in terms of the specifics around production, so
my pessimism.
Oil companies don't really care. I mean, the big companies care more about this stuff. But if you're looking at a small company, I was looking at recently a prospect. I may end up starting a small oil company with a couple of friends. I think do that simultaneous with the running the fund and investing in publicly traded ones. There's this really interesting opportunity we're looking at going and buying. And for that, it doesn't really matter. We go buy a field that's producing, let's say, 2,000 barrels a day and take it to 5,000 barrels a day. Yeah, if Biden's terrible and it costs twice as much for lawyers, let's say it costs $400,000 for lawyers instead of $200,000, and it takes 6 months instead of 3 months, we'd still do it because the opportunity is really, really good. But as things get sort of more marginal, you get rid of some of that activity. So on the margin, you're going to have less production. On the margin, you're going to have less activity. But it's really hard to sort of, again, it gets back to really strong civil society in the US, huge advantages that we've essentially inherited from our parents and grandparents, the hard work that they did, and the leadership that we experienced generations ago, and sort of the people that started the country and how they organized it and so on. So I think it's really hard to sort of attribute almost anything to either party and any leaders, and it's all about sort of the marginal impact of things. That being said, the rig count's down about 160 year over year, and the drilled uncompleted well count is down tremendously too. So we've been fracking wells. that weren't drilled recently. So we're sort of burning the furniture right now. So we need to see the rig count go up. And I think it's going to go up. We'll see. I think it's going to go up about 50 rigs in January. And I think people are going to say, oh, this is very bearish. And the reality is, if you want production to not fall 2 million barrels a day, you need probably 50 more rigs. You might need 100 more rigs to continue anywhere close to the recent trajectory. And you probably need 200 to accomplish the growth that was accomplished in 2023 and 2024. And then you need even more the next year and so on because of falling well productivity, all kinds of challenges. There are rig efficiencies, but then they're offset by formations getting worse and higher decline rates and higher gas percentages, lower oil, issues with NGLs. There's all kinds of challenges there. So what will happen in the future depends a lot on the activity that gets engaged in. And a lot of what we're trying to do at Bison is find companies that should benefit, absent a collapse, right, should benefit from a lot of different economic situations and a lot of different price environments. So for most of these companies, it's going to be worse and they'll do less if there's higher taxes and more regulations, but a lot of the impact is marginal. And because it's marginal, most people don't engage in it, which is why you're able to have things get worse and worse from a policy perspective without business people responding too much.
I think I think that the best line of the show is we're burning furniture.
Oh, no, I love that. Yes. And
That is
actually, I was going to ask, really, you said we're down 160 counts, but put some broader context in that. Like 160 of what? What percentage is that? 160 rigs, we're down from what?
On the oil side, I think we were at 700 and something.
It's significant as shit. Yeah.
Yeah. So it's material. It's sort of in that 15 to 17% type drop, which is material. When you look at the number of rigs you need to run in order to sustain existing production, it's not, like I was saying, it's not clear that you can actually sustain existing production with 600 rigs. Like you might need, I've seen some analyses that say maybe we could hang in there at the current rig count, but even those, they're not exactly sure. And it's not really clear what they're going to drill in order to do that. And some of the locations that were drilled this year that were fantastic, they don't exist. I mean, none of the locations drilled this year exist anymore, right? So it's always people drilling their best ones first, and then the next best, and the next best, and the next best. So the wells we're drilling now are way worse than the ones 10 years ago. They only look almost as good because of all the technology, like you were saying. There's been enormous innovation. These companies are fantastic. Jimber's totally right on that. They are tech companies of a different sort. So the real question is, hey, like what's the maintenance activity level? And I think it's higher than the current rig count. And I think it might be substantially higher, and we'll see. But the really important point is that the Permian was basically growing 1 million barrels a day a year for a number of years prior to COVID. And we're getting back to pre-COVID levels, and we may be slightly above that. But we're not growing 1 million barrels a day a year, and you probably need 400 more rigs to be able to get back to that 1 million barrel a day a year from the Permian, incremental. And even then, if you added that many rigs, you'd add 200 or so just to the required, just to keep production flat after that. So our production growth trajectory has slowed down a lot, and that means that the oil market is very different than it was pre-COVID, and it's a lot easier to be bullish, and there's a lot more things that can happen that can send prices higher, and there's a lot fewer things that can send prices lower versus this current sort of mid-70s level.
Are you guys both, are you saying in a roundabout way $150 barrel oil in 3-5 years? Is that what you're saying, Bobby? Is that what you're saying, Josh? What are you guys saying?
I don't know if Josh will put a price on it, but I am. I'm saying that if things don't change. And again, the problem is, like, one of the things that drives me crazy as somebody who pays attention to energy markets is the idea that they get politicized by the public. It'll be the same thing like you see people put out this idiotic stuff where the stock market goes up under Democrats, down under Republicans. That doesn't mean anything. If it were reversed, it wouldn't mean anything. And now you're going to have them saying, well, we produce more oil under Democrats than we do under Republicans, as if that matters. That's like saying that I gain weight when it's sunny out and I lose weight when it's rainy out, and my behavior doesn't change at all. It's completely nonsensical. The two things don't go hand in hand like that. So yeah, I am, because I don't necessarily believe, first of all, I don't know what's going to happen in the next election, but I know that if things don't change from a policy perspective, and I will follow suit with a lot of other people I've heard say this, we don't have a coherent energy policy, period. And based off of that, I see oil shocks happening.
Okay, so Josh, if you don't want to put a price on it, that's fine, or you do. We didn't ask you yet. But are you comfortable with saying?
So hold on. What was I saying?
Oh, he's got something.
This is my hat from my buddy Cuppy made these.
250, it's
250. So here, I'll put this on. You guys are saying I was a little overdressed for this interview, so here
Now you're perfect.
Awesome.
So this would be the inflation adjusted all-time high for oil. And I don't know, is it going to be next year? Is it going to be 5 years from now? Is it going to be 7? I'm not sure, but I think there's a good case for oil prices to go to all-time highs, both because they're cyclical and there is a tendency for cyclical commodities and cyclical industries to reach all-time highs in up cycles, as well as when you look at the supply base for oil, as well as the demand trajectory for oil, absent some real significant shock, another COVID, another whatever, we're on track for this. So, I don't know about exactly 250. I think it's sort of cool. It was a little bit of a jinx. It came out right as oil got to 130 in June of 2022. So, it's sort of it called for a temporary pullback and a temporary pause. But, over the longer term, with the underinvestment that we've seen with the growth in demand. I mean, demand grew by over 2 million barrels a day this year, way above expectations. OPEC says it's going to grow by another over 2 million barrels a day next year. The IEA, which has always been wrong, says it's going to grow by 800,000 barrels a day. So the news says it's going to grow by 800,000 barrels a day. We're in a big oversupply of oil. And it's like, well, hey, check your source. And then, what's that mean? So anyway, I feel good about this. And I think it makes sense.
Okay, last question for you. And again, this is, if you don't want to answer this, don't answer this. You look at the candidates that are all running. Do you think one of them is a superior energy policy person than the rest running for president? We don't talk about politics. We talk about policy here. You know what I mean? I don't care about politics.
I understand. I thought that Ron DeSantis is an incredibly effective governor. And based on the way he's navigated policies in Florida that he inherited versus how he's navigated, I think he's shown the ability from a policy perspective to navigate things effectively. And frankly, his energy policies sound very similar to Trump. They sound very similar to Vivek and to a couple other of the Republican candidates. And again, lots of problems with the Republican Party, lots of problems with the Democratic Party. I'm not endorsing anyone, but of the candidates, given their track record combined with what they're saying from an energy perspective, I think DeSantis probably has sort of the best, his governing track record plus most reasonable things around energy policy.
Makes perfect sense to me. Bob, you want to call it at that?
Yeah, I just want to throw in for me, it's Vivek, because I agree on the DeSantis stuff. I live in Florida. I wanted him not to run because I didn't want to lose the last 2 years of him as governor. I wanted him to stay here. But Vivek's whole idea of, taking on the people that are called climate change deniers, taking on the climate cult really resonates with me, because it's not about whether the climate is warming or not. It's what are you willing to do to change it? So, and I'm not sure that there's necessarily anything, the human cost of trying to change this policy, the way that the left is describing it is insane to me. And I just got a comment, hi Josh from Naples Runner. So I'm not sure if that's, actually I know who that is. Obviously he's a friend of mine, but he said,
I know who it is too.
Yeah, he said say hi to you in the comments. So.
Cool. Thank you. So I like Vivek. I think he says a lot of things that make a lot of sense. I think we've learned that some of the best leaders are people who have demonstrated success in leadership doing something similar. And some of the worst have been people that have demonstrated failure doing something similar. And I feel most comfortable as someone who's, I think moderate fiscal, moderate social, sort of leaning libertarian. I feel more comfortable with someone just who's already done it to some extent. Just betting on doing what they've done and in a sort of orderly way without too much sort of local. You don't hear about like giant local issues too much with DeSantis. Like he's just sort of been a very, I think, effective and placid, and I think maybe the country could benefit from someone like that too, just in terms of the ability to like make a lot of necessary improvements while also not sort of blowing the whole thing up or starting a civil war. So that'd be nice too.
That'd be nice, right? Thank you. Where can they find you? On Twitter at?
Yeah, at Bison Interest or at Josh_Young_1 or bisoninterest.com.
Thank you so much. This was a great show. I really, really appreciate you being here. Thank you.
Absolutely.
By the end.
Send me one of those hats. I'll wear it.
Love it. See you, Josh. Thanks.
See you, Josh.
Awesome.
Thanks.
Thank you. Okay, take care.